my record on. Okay, so we went through the accounts the other day just to make sure that you knew where everything needed to go. So we had under our current assets, cash, accounts receivable. This is supposed to be prepaid insurance. Oh. Did we go over this one the other day?
No.
No? Okay. I feel like we did, but. I just want to change that. Because I will often just use the, okay, so this should be insurance. Okay. So we had, I'm just going down the list in the book. We had cash and prepaid insurance. We knew those were current assets. Land, we said, needed to go to plant, property, and equipment. And since land is not depreciated, it goes here in the middle column. We had accounts payable, which was a current asset. We had accounts receivable, which is a current asset. Accounts payable is a current liability. I don't know what I just said. Okay. The other thing is when you're looking at these things, a couple things to watch out for. Payables denote that it's some kind of a liability. Receivable will always tell you that it's some kind of an asset. Prepaid is always some kind of an asset. Any of the things that go here should be very obvious. Land, and then anything that has depreciation, anything that you need to reduce the value as you use it would go under here. The ones that are a little less obvious are the things like the other assets, which would be your copyrights, trademarks, patents, those kinds of things, franchises, definitely for this industry. And then the investment piece, just watch the time period. If it's a short-term investment, it's going to go under current. If it's a long-term investment, it would go under its own category, and it would be right in here. The other thing is you want to make sure you put the stuff in the right order. So on the asset side, current assets, investments, PP&E, and other. Because if you don't put it in the right order, I will take off for it. Okay, taxes payable. Again, payable says it's a liability. Think about it. Is the government going to wait for more than a year to be paid? No. And so that makes it a current liability. The mortgage payable, you have a long-term portion, which goes down here. You have the current portion, what's due in the next 12 months, that will go up here. Equipment and building, we said because they have depreciation, they go here. Now, this one is different than the one I showed you the other day. The one I showed you the other day, the depreciation was broken out between the building and the equipment because they have very different lives. Buildings can be depreciated over like 30 years. Equipment most of the time usually has a life of about 5 years. So there's very different depreciation. And this really doesn't show what the value of the building is or what the value of the equipment is because I don't know where this 100,000 it goes. But if this is the way that it's given to you, this is the way that it shows up. We said the other day that we use 3 columns. The asset side is really the only side you're going to use 3 columns. The liability side, you're only going to use 2. This first left column is all your busy work. The only things that should be here would be the accounts receivable less the allowance up here. And in PP&E, it would be this stuff here. Cost of buildings and equipment less the depreciation. This is where you're going to put the middle column is where you put all the stuff that you're going to add up, which is why this is the net value of this work right here. And as I told you, in your right-hand column, at most, both sides, 5 numbers. The asset side, totals for current assets, investments, PP&E, other, and total. If you don't have them, you don't have to put them in. Liability side, you're going to have a total current, total long-term, total for liabilities, total equity, and then your total. So again, you have 5. The other things that we have on the list, we have the mortgage payable current, which we already talked about. It's going to go under the current liabilities. Inventories, again, think about it, especially if you're in a restaurant. Your food inventory should be not very big, and it should be turning over because your food inventory is product you're going to use, not going to have a very long shelf life. So you want to get rid of it quickly and get new. Wages payable, again, think about it. Are your employees going to wait to be paid? No. So that again would be a current liability. And we saw from the adjusting entries, because like I told you, the adjusting entries never go away, that the wages payable was set up to record the wages at the end of the year that wouldn't be paid until January. And so most likely by the end of January, this would be back to 0. Okay, that would be back to 0. The last one, there's a capital account, which we said we had to figure out in this one. Because this was a sole proprietor, our equity is just the capital account. And then we had our accumulated depreciation that went over here. Questions so far? Okay. So you're going to take all these current assets and you're going to add them up, and that's your total current. You're going to take your land. We're going to figure out the net value of the building equipment less the depreciation, which is that. That's your total PP&E, which is these added together. Total assets, all your categories, and we only have 2. So it'll be total current, total PP&E. One of the other things, and this has to do with how you set stuff up, every time you see a line, it means you're going to do something mathematical. So here's this line, I'm adding up. Okay, here's this line, I added those and subtracted and got that. There's a line, so I'm adding those to get this. Double underline means you're done. So nothing is going to be added to that number. All right, questions on the asset side? Okay, over here to liabilities. Current liabilities, again, anything that has to be paid within a 1-year period of time. Accounts payable, we know our creditors are not going to wait. Typically what happens with creditors, once you hit 30 days, they start putting on finance charges. So you're going to want to pay those. Mortgage payable, that's the principal part that needs to be paid in the next 12 months. You don't pay that, the bank's going to come after you. Taxes payable, again, need to be paid so the government doesn't come after you. And your wages payable goes to your employees. And again, that's usually just the last part of December, which would be paid in January. Line, add them up, total current liabilities. With the long-term liabilities, if there's only one, it can go right out into the right-hand column. If there were multiple ones, you would set it up just like this. List them, do a total, and then do your total liabilities. So with this one, we had to find this number. So what we would do is do the asset part, take our total assets, subtract off our total liabilities, because we know that the total liabilities and the equity account have to equal assets. That was probably the very first thing you learned in financial accounting, that assets have to equal liabilities plus equity. So if I take this, subtract this, I get 557. And then again, once you add those two together, you get that, and make sure that they're equal. So when you're doing balance sheets and they don't equal, find out what you're off, look for that number, look for half of that number, because sometimes you put it on the wrong side. All right, questions on that one? And if you have questions, ask. I was teaching yesterday and I'd done about 15 minutes and they go, well, we don't understand. So we went back over it. But if I don't know that, I can't do it. Any questions on number 2? Any questions on number 2? So you can ace it and you're good.
Yeah, I don't have any questions.
Yeah, 2 is straightforward enough for me.
Yeah, I think so too. All right. So then we're going to go to the next one. So this next one was just really to give you some more practice in setting up. And then I'm going to show you what the problem actually asks you to do. So this is number... I'm in the right chapter.
13.
Thank you. I was looking on the left page, not the right page. If you guys like a challenge and like to play with stuff, look at number 20 and 21 and 22. Those are just kind of fun, I think. You guys won't think, but to fill in the blanks. Kind of get you making sure that you really have the, have it down. Okay. So number 11 actually asked you, or 13, sorry, asked you to do a common size balance sheet, which I'm going to show you, or a comparative, sorry. But what I wanted you to do is just practice doing 2 separate balance sheets. And again, with this one, they did identify what the accounts were. And so we had cash, accounts receivable. Now, if you come across marketable securities, this is a first time with that one. It goes under current assets because they're usually short term. You might be just buying stock, waiting for it to go up and then selling it. Inventory. Now, operating equipment, this is the first time we've seen this, but they're telling you to put it in current. And this is what we talked about the other day. This is where you're buying the china, the linen, the glassware. And I say it can either be a current asset or it can be an other asset. And I said, I would take it either way. I don't care. But in this case, they told you it was current. Really, the difference would be between the two is it would go into other if you have bought a huge quantity of something that you can't possibly use up in a year. Prepaid expenses, We said go here. So this one over here is the first year. Any questions on the current part?
No.
Okay. And then all we
I
have,
actually do. I got tripped up because of the word equipment, not knowing what that was, and I put it under PP&E as opposed to under assets.
okay. So it's either going to be labeled as operating equipment, or sometimes you'll see it as china, linen, glassware, but it's the same thing. It's nothing that's going to be depreciated.
Okay. So that's the key
Yeah.
for,
Yeah.
okay. So if in doubt with something as basic as operating equipment, not knowing what that was, if you were looking at this randomly, you would assume current asset more
Correct.
likely? Okay, thank you.
Yep. And actually they did label it current. Well, I look in the book, but that's what it is. And usually you see it as specified as china, linen, and glassware, more so than you see it like this. Okay, the other part of the assets, we had land, we had building, we had accumulated depreciation. Remember, accumulated depreciation has a credit balance, so is always subtracted. This is the value of my building. That plus my land, that's my total plant, property, and equipment. So my total assets. The second year, exactly the same, except different numbers. And so if we look at this company from one year to the next, we can see our cash went up. Our accounts receivable went down, which could be the reason that our cash went up. We've collected on our accounts. Marketable securities only went up $100. Now inventory went up $4,000. That might be something we need to think about, depending on what type of business this is, which it doesn't tell us. Number one, if it's a restaurant, you certainly don't want your inventory to go up that much because that's food. You don't want to have that much food on hand. Depending on, again, the type of business, if it's a business that product becomes obsolete quickly, you don't want to see your inventory going up. So for example, someone who sells computers or phones, okay, they're obsolete and new ones are out the next day. So again, it's not something that you're going to want to keep a lot of. People aren't going to come in and buy the old stuff. They want to come in and buy the newest stuff. Operating equipment, so they've purchased a whole bunch of glassware or linen or china or something. And again, you would want to make sure, just be careful with this, that you didn't get that too big. Prepaid expenses went down. So we have expensed part of those prepaid expenses. Not much change here. Land, of course, didn't change. It went down, but we would expect it to go down because the depreciation is going to increase because they're going to put the depreciation for X2 in there. And so therefore, again, the value of our building goes down, which again makes sense. Questions on the asset side? All right, let's go to liabilities. Okay, so again, they have it classified for us. I won't be that nice, told you that. Current liabilities, standard ones, and be careful with this. Accrued expenses are current liabilities. Keep that in mind. For some reason, they get forgotten when we do other stuff. Just keep in mind they are current liabilities. Again, our long-term debt, current portion here, long-term portion here. That's all we have for our current liabilities. And then this one showed up. So we talked a little bit about deferred income taxes. And deferred income taxes can be debits or credits, current or long-term. And they have to tell you what it is. So with this one, they told you that it was non-current. And it's listed with your liability, so it has a credit balance. So deferred income taxes come about. So a company can do their income statement on their books, calculate their taxes. And then when they actually do their taxes, it may be done a little differently. And usually the difference has to do with how depreciation is calculated. Because depreciation has to be calculated a certain way for your tax return, but companies may not want to do that on their financial statements. And so what happens is the tax on their books is different than the tax on their income tax return. And that's where this deferred income tax comes in. So depending on which way it goes, that determines whether it's a credit or a debit. So in this case, we had two long-term liabilities, so we're going to add those two together, bring it over here, and then total our liabilities. And remember what I said, your book does not show this total liability number. It needs to be there. And again, I will take off if you don't. Remember the 5 rule, 1, 2, 3, 4, 5. This is a corporation. So we have common stock, we have retained earnings. Retained earnings, remember, is the company's way to include what happened during the year. So it's increased by net income and decreased by dividends declared. And that's how you bring what happened on the income statement over to the balance sheet. Same thing happened over here. Not a lot of changes that we would necessarily look at here. The current liabilities changed a little bit, but again, we would expect this to change because the principal part for the next year should be down a little bit. Or shouldn't be, actually, it should be the other way around. But they may have incurred more debt. Did they? Okay, so our long-term debt from here to here, if you notice, and it doesn't quite work out the right way, up here. So if I take the 553,429 and subtract 533,369. Okay, so what they did is at the end of this year, they said, okay, how much of that's due next year? And they took it, and this is how much is due next year. If you look at the difference between this long-term here and long-term here, the difference is this amount right here. And that's going to come into play when we work on cash flows. Okay, so again, total your long terms, we would expect that to go down because they didn't take out a new mortgage and we paid off some. So there's our total liabilities. Our stock account did not change. But what happened in retained earnings? What did it do?
dropped a lot.
dropped, okay? And so that's something that we would probably want to look at. So it could be a result of a net loss for the year, which we would see on our income statement. Or it could be the fact that they paid out a lot of dividends. That will also reduce our retained earnings. That we usually like to see go up. All right, so that was just to practice some more. The thing that this asked you to do, and this is something that you will come across in the real world because it lets them see what's happened from one year to the next. It's called a comparative balance sheet, and I just want to show it to you. So it's the same exact numbers, they're just not in pretty format. But what you're doing is finding the change in all the accounts. And so this is where you can go look at what happened in your accounts and say, okay, I need to go check this out. So this is the difference between these two. So it's always the new year minus the old year. And then you're going to take that difference. And if you want to find the percentage change, you then take this number and divide by the old year. So that's what it changed by to go from here to here as far as percentages go. So if we look at this stuff, sometimes the increase is good and sometimes it's not. Sometimes the decrease is bad, but sometimes it's not. So here we had an increase in cash. We said, that's good. Here we had a decrease in accounts receivable. That's good. Means our customers are paying us. So even though that's a negative number and a negative percent, it's a good thing. This didn't really change much. Inventory went up 27.5%. That's a concern. So that's something we would want to go look at. Again, we would want to have all of the financial statements because I would need to see what's happened in my sales. Operating equipment. Okay, so we've been on a buying spree, bought lots of china and glassware, and our prepaid expenses went down. Not significantly, not a big deal. Plant, property, and equipment. This is exactly what we would expect to see. Because of the depreciation, we would expect that to decrease. So unless we've gone out and purchased something more here, typically you would see a decrease because of the depreciation. On the liability side, not a lot of big deals here. Yes, all of our accounts payable went down. That means we're paying on our bills. That's a good thing. Nothing really significant. Our accrued expenses, we just paid off a bunch of stuff. That's a good thing. And then our long-term debt, okay, has gone down a little bit. Down here, again, nothing really significant. We would expect our long-term debt to go down because we moved this to current. And then down here. So this is where that kind of stands out. That our retained earnings went down 22%. That would be a concern. And so this is the type of stuff. This is a really good thing to do when you're doing your financial statements, if it's not already done for you. And so what you would do is you would go say, okay, let's go see why this happened right here. And go look at their income statement. Go look at their dividend policy and what they did. That's the kind of research that I want you doing. Sorry. All right.
One question on that. Would you normally, for the percentages, go to 1 decimal or 2?
That's kind of a personal preference. I usually do 2, but your book will usually do 1.
Okay.
I like
Because
the
yeah, when I
defined-
was doing it, doing the example, working it out, I had done it to 2 because that's what I was used to seeing. So,
Yes.
but I saw in yours it was 1. So
Yep.
I just wanted to check that 2 would be fine if that's what you were to see.
Oh, absolutely.
Okay.
More is always better. All right, questions? Okay, so let's turn to page 84. And just kind of go through a couple more little problems here. And then I will put it out there for questions. And we'll go from there. Okay. So problem 24 just has a list of accounts. And let's just go down through them. Identify what they are. Some of them you're not going to know, but we'll talk about them. All right, accounts payable. What kind of an account would that be?
Current liability.
Current liability. Okay. Obligation under capital lease. Does anybody have any idea?
Would that be an asset long term?
Okay, it's not going to be an asset. The capital, whatever it is that you have would be. So, and I think this probably occurs often because you have huge pieces of equipment that you need. And lots of times you can't just go buy those. And so you have these capital leases. And so what it is, at the end of the capital lease, you would actually own the equipment. And so the obligation under the capital lease would be a liability. It's kind of a way to finance the purchase of the equipment. And then at the end of it, you would have the equipment. So with that being said, it would be a liability. The obligation for the capital lease would be a liability. And it would be long-term.
So if
That's
it says obligation, then it's a liability.
Yes, exactly. Okay. So I said there's a couple oddball ones on here. Common stock goes where?
Stockholders' equity.
Yep. All right, what about income tax payable?
Liability.
What kind?
Current, short term.
Okay. All right, so now here's another one. What do you think about gift certificates and cards?
That'd be a long term liability.
Okay, it's a liability. Good. It would be a liability, but it would be current. Most of the time, they're not going to be for a long period of time. If someone's got a gift card, they usually do them quickly.
Okay.
Or they lose them and not do them at all, right? Okay, all right, here's another one. What about treasury stock? First of all, what is treasury stock? Come on, some of you were in my class last semester. Nobody guess? Good call on a couple of you that I knew were in my managerial class. So treasury stock is when a company goes out and buys their own stock. So a couple reasons it could happen. Maybe they want to drive the prices up. So what they would do is buy their own shares back, less stock on the market, hopefully drive up the prices. Sometimes another company is trying to take you over. So if you go buy the shares, so they're not available, then they can't buy them and do a hostile takeover. if you have treasury stock, it's going to go with your other stock accounts. So it's going to be in your equity. But treasury stock is the opposite of everything else that we've done in the equity account. It has a debit balance. And as long as the company is holding it, it would be in your stockholder equity section, but it would be subtracted. Now they can totally retire those shares of stock. And when they do that, the treasury stock account goes away and there's a change in your common stock account. So what we need to know is if you have it, it goes under stockholder equity. It has a debit balance, so you would subtract it. Hopefully that brings back memories from managerial. Okay, advanced deposits. We talked about these. What would they be?
Liability.
Okay, what kind?
Current.
All right. So that's when they give you money to hold a space or book an event. They have a certain period of time that they can get their money back. Until that time period is up, it's a current liability. After that, they either get their money back and it goes away. They do the event. We apply it towards their event revenue. Or if they go past the date and then don't do it, then it becomes revenue to us and we'll move it into the revenue account. Okay, mortgage notes not non-current. What would that be?
Long-term liability.
Good. Deferred income taxes, current. So that can be one of two. They need to be more specific. That could either be a current asset, if it has a debit balance, or current liability. So that can go either, but it would be in the current. We just don't know which side. Here's another one. Additional paid-in capital. Anybody remember what that is?
You said additional paid in capital.
Yeah.
That's when I believe that's the amount. Sorry, I'm a little brain dead right now. When you eventually, when you have treasury stock and you sell it back, that's the amount of money that you made off of it, I believe, or the amount of money that you get in return, if I'm
Okay.
remembering right.
Close. So additional paid-in capital can go with common stock, preferred stock, or treasury stock. With your preferred stock and your common stock, you have a par value that's assessed to your stock shares. When you record the sale of stock in your stock accounts, you're taking the number of shares times par. That's all you put in those individual accounts. Anything extra that you get when you sell that stock goes into one of these APIC accounts. And you would have one for common stock, preferred stock, and treasury stock. So it's the extra that you would get. Common stock, preferred stock, it's above par. Treasury stock, it would be above whatever you paid for it. And so that's just the extra. So for us, with what we're doing right now, the thing to remember is it's going to go in your stockholder equity section. And it would be added in. It has a credit balance. Okay, accrued expenses, where's that go?
Current liability.
Current liabilities. And what about preferred stock?
Equity.
Yep. Okay. All right, questions?
I just have a question for the deferred income taxes. You said it can be either a liability or an asset. So how would you be able to tell whether it'd be a liability or an asset?
They need to tell you.
Okay.
they need to say it has a debit or a credit balance.
Okay.
So it's based solely on whether it's a debit balance or a credit balance. If it's a debit
Correct.
balance, it's a current asset. If it's a credit balance, it's a current liability.
Yeah.
Okay.
Okay, anything else? All right, you have multiple choice quiz, which is due tomorrow night. You have problem number 5, which is due tonight, right? That's your balance sheet for tonight. Upload it on Vanco. And then you have that piece of your project, which is a really small piece, so don't get all panicky that you have all this work to do, for Sunday night. Monday, during class time, test on balance sheets. And then I won't actually see you until Wednesday, when we'll really start to get into hospitality accounting. Start working on the income statements. Questions? Okay, I'm gonna stop my recording.
Sorry, for one thing, for the homework, since it's just doing a balance sheet, that would sort of be in the same format then that we went over for problem 11? Is the format you would expect it in?
Hold on one second. Why is this not? Okay.